that yeah, it's probably not going to double again this year, I guess and it's already down 28%. But we need to move on to our guest for today, Mish Schneider of MarketGauge, and we'll get to her in just a second. All right, we welcome on Mish Schneider of MarketGauge, Chief Strategist of MarketGauge. She has just put out recently Market Outlook for 2025. It includes top 10 picks. That's on the marketgauge.com website. Mish, welcome. Thanks for joining us. Lots to talk about in the market right now. So we'll get to as much of it as we can. Talk a little bit about, your investing style and background and your approach to things.
Okay, well, first of all, it's great to see you again, Chris. We got a chance to meet on the Money Show top picks this year, so
That's
that
right.
was fun. And thanks for having me on today. So yeah, I mean, I've been in this business a long time, and I started actually as a trader on the Commodities Exchange in New York. And I was there for the hyperinflation moves as very young, granted, but I was there. And so I really got to experience what it's like, first of all, to catch a parabolic move and what it's like when that parabolic move is over. And so I think that really has been my style of trading, is that I try to get in as something is emerging, momentum is increasing. Of course, back then, momentum, you could hear it, you could feel it, you could see it, you could taste it. But now momentum is more measured through certain indicators that we have proprietary at MarketGauge. But nonetheless, the idea is the same, is you get in, the momentum is increasing, you get some kind of a good parabolic move. And even if not a parabolic move, if you get a good move, let's say 2 or 3 times what your initial risk was, you take profits, you have trailing stops, and this way you never go from a parabolic move to a major loss, which is something I think a lot of people have experienced over the last week in the market. So that cut my teeth, and I love commodities. Obviously, I had to spend a long time waiting for them to pop up again, but COVID kind of brought them back to life. And so that's that. But I also trade a lot of stocks. I try to keep to a theme, which again would be more of a sort of a commodities market mentality, which is whatever was hot in the commodities market is what you traded. And if it weren't hot, you didn't go near it.
Right. And you have something you call an economic modern family. Talk a little bit about what that is and what you look for there.
Well, I do have a master's in special education. So I did start out life in special education. And then through the years, I've done inclusion consulting in school districts, which means basically I'm modifying curriculum, general education curriculum, to make it accessible for kids who have all different types of disabilities. So that's kind of how I think. And when I started in the whole stock space, which really was right after the crash of 2008 is when I got started, I needed a way to explain to myself the mechanism of the U.S. markets and the economy. And so I started to think about them as a family with visuals. So I actually have cartoon characters and dolls that represent these sectors. So they would be small caps as the granddaddy. And as we know, even though we've seen growth dominate, small caps ultimately rule, particularly in this administration because there's so much emphasis on what's happening in the U.S. Then retail, of course, is 70% of the GDP. That would be granny retail. And actually, and I say she, but she kind of gave me the clue that we were going to have this sort of big correction that we've had. And then it sort of wraps up with transportation, semiconductors, biotechnology, regional banks, and my newest member would be crypto.
Who is crypto in the modern family?
So crypto is the tween, kind of like at this age.
I have one of those.
Yeah, you have a tween. So they don't really, they can be volatile.
Yes.
And their hormones are raging and they don't really know what they want to be yet when they grow up. And that's kind of, I think, a really good metaphor. My cartoon character of crypto is kind of like millennial looking with the man bun, smoking a doob, because and with I try to make them amusing and memorable, and yes, a little bit stereotypical, but that's how you remember things, right?
Right. Brad, go ahead.
I want to go back just because like this really stood out to me. You said you came up essentially when inflation was raging, and that is obviously like one of the biggest fears on the street right now is that inflation's going to creep back up, tariffs are inflationary, excess spending inflationary. So how are you playing it right now?
Well, again, I'm a very linear thinker, right? That's why the family emerged, and the same thing with inflation, because what I noted back in the day were there were really what I call the trifecta of inflation. So number one would be the silver to gold ratio. So even though we've been buying gold, and I've been calling out gold for 3 years as a great buy, really what I think that's been more flight to safety. What would make it more of an inflationary play would be if silver starts to outperform, which back in the day, that's exactly what happened. The ratio right now is where gold is about 90 times the price of silver. In 1980, it went to only 17 times the price of silver. So there was your flip. And I think if that ratio breaks down under 80, that would be indicator number one that we're going into a higher inflation. Number two would be the dollar. So the dollar broke down, but not really. It hasn't really crashed. It's just been more in a range to me than anything else. But back in the 1970, 1980, obviously purchasing power went way down. And the third, believe it or not, was sugar futures. And that's something that most people don't really think about. But I learned back on the floor in those days that sugar actually rallied before the gold and the silver, and then even in 1980, the sugar rallied again, went from like 3 cents a pound to 45 cents a pound. And what does that mean? Yeah, there could be weather issues, of course, with crops, but it's usually something that is in everything. So it's like a staple, global staple that people will hoard in tough times, and in inflationary times they'll reach for things like that as opposed to whole foods, for example. So if you put all those together, that's really, I think, a great picture. And to date, even though we're seeing inflation and it's been nuanced, are not really seeing at this point the 1979 1980 narrative setup. It doesn't mean it won't happen. And certainly we're seeing inflation in areas, but at this point right now, it's all conjecture that it's going to get much worse.
Can I ask just one clarifying question on sugar futures? Given that the prevalence, at least domestically, is now high fructose corn syrup, should we be looking maybe at corn futures as a proxy or substitute for that?
Well, I'd say yes and no. Because, again, you're thinking about it with American eyes, but sure. Yet, a couple of years ago after COVID in some African nations, there were literally fights breaking out in supermarkets over a pound of sugar. So I think you have to look at it globally, number one. And number two is, yeah, we're all very health conscious. And of course, we're going to get into the whole vanity trade that I'm calling with diet drugs, et cetera. But the point is that it's still it's in everything. Maybe not in the way of corn syrup as much, although it still exists, but it's really like if you pick up anything, a can of anything, or a box of frozen food, and you look at the ingredients, sugar's in there. So it hasn't quite become the devil that people would like it to be. And as you're sipping, what are you sipping right there? Is it sugar-free?
Yeah, seltzer water.
Oh, there you go. So no sugar.
I swear I was just taking a drink. I was not trying to be like prove a counterpoint or something.
No, the timing was interesting. All right. Anyway, I hope that clarifies. But yeah, to your point, Brad, corn and wheat and soybeans, also really important. No doubt about it. And corn took off, wheat took off, and soybeans took off, but they've all come down a little bit, which is why I say the big inflation narrative at this point is more conjecture, and we haven't really seen it in the price.
Yeah, so that was what my next question is. What's your concern level about, inflation worsening? Sounds like maybe not terribly high.
Well, a lot of this recent talk of inflation going to a much higher level. Well, first of all, let's face it. We know that inflation has increased. We saw CPI sort of flatten and has been inclining. The PCE numbers that came out on Friday, showed consumption is down, but prices are still up and wages were up. I mean, there's all these different signs that anything could happen. Deglobalization in and of itself is inflationary. Obviously, we just showed that we're willing to raise the debt ceiling as opposed to lower it. We're still doing a lot of spending. All these things can come back and haunt us for higher inflation, no doubt. And of course, the tariffs in and of themselves. But at this point, I still have to see it in the price. And that's why I use that trifecta. That doesn't mean I don't think silver can go higher, gold can go higher, sugar can go higher. Oil would be a next factor. That could even go higher. But at this point, it hasn't gotten to the point where I'm ready to wave the flag of, fasten your seatbelts because here comes hyperinflation. All we're seeing now is a rising tide and a lot of fear.
Right.
So are you just, if you see that the silver gold ratio dip below or gold silver ratio dip below 80, are you just immediately hitting buy on silver, or is there a specific play that you're looking at?
Well, I would certainly be buying silver. I'm already been buying silver since it was trading at $20. And same thing with gold since it's been trading at 1,500. But I'm also doing commodities trading mentality. I'm taking profits on the way up and then waiting for dips to look like they're buyable dips. I might change that to chasing rallies. See, right now, every time silver looks great, it sells off. Every time it looks terrible, it's a buy. When that changes, when it goes, orange juice futures or cocoa futures or coffee futures crazy, which we saw all three of those go nuts. That's when you keep adding. That's that compounding mentality that happened on the commodities exchange when something goes parabolic.
What are some other mega trends or sectors that you really like right now?
Well, I think what has really saved me from losing my mind this year as a trader and watching these massive corrections is to think thematically and then stick to those themes. So, a lot of people came into this year thinking that we'd see a market broadening and that we would see more value plays. And we've seen a bit of that, not enough yet. That doesn't mean it won't happen, but clearly the sell-off has hurt that a bit. So in that thematic trading, what am I looking for? Well, definitely one would be watching that trifecta of inflation that I was talking about. But secondly, with everybody that ran into AI and tech, I'm looking at more of what hasn't really happened yet that's more futuristic, that has a really good solid base. So robotics would be one. And, we've been this area of anywhere from $22 to $24, let's say, in a stock like Symbotic, which is probably the premier robotic company. It's expensive. It takes time to install. But in terms of fulfillment and efficiency in warehouse, it can save a company like Walmart, who uses it, millions and millions of dollars. I think that's a future. I think that quantum computing, Amazon has been talking about it now. Lately, it's been headlines. I think that's a future that first was doing great, and then Jensen Huang said, oh no, we're 15, 20 years away, and then Bill Gates came out and said, no, we're really only more like 5 years away. But no, regardless, these prices are cheap down here. And then the emerging markets would be another, where obviously China turned out to be a great trade. I'm looking at Vietnam. And then I think the final, and I won't say final because I'm always open to new things, but I've really been keen, and I think this is a mega trend in infancy, on what I'm calling the vanity trade, which is really the domino effect of these diet drugs. And what changes we have in the consumer as a result. So you have to be looking at skincare and beauty and, AbbVie, which was my top pick, by the way, on the Money Show.
Yep.
While this market has been selling off, that thing has been rocking and rolling. In fact, right now it's trading up at 2.0, almost 206. I think that reflects it. Partly immunology in that company, but also they do Botox. So you have to look at like Nike and fitness and stay away from things. Back to your sugar point, Brad, because they're starting to move away from eating fast food and eating junk food, people who are on these diet drugs, and it's growing. And the announcement this week that Eli Lilly is coming out with a cheaper version of the diet drugs, and also building 4 plants in the U.S., spending, I think, something like $27 billion, which brings me to my final theme, which is made in the USA. All of that, I think, is something to keep an eye on, how these consumers who are now thin and going to stay thin spend money.
That it's very interesting that you bring up the vanity trade. We were fading alcohol specifically. Was that last year, Chris?
Yeah, I think so.
I think last year, just seeing like millennial consumption trends specifically, and I think that goes hand in hand with exactly what you're talking about, which is, you know, the wellness prioritization. And it's like, okay, well, probably Coke and Pepsi are going to keep paying dividends, and they'll probably keep doing fine. But I think there's room to fade some of those names.
I totally agree. And so I don't necessarily look at what I can sell as a short, but more what I can look to buy that has been, again, hinging on the lows. I mean, let's take a silly stock. I say silly, but it's a huge company. And you hear it all the time on social media, but Match.com. It's gotten beaten up. That's another classic stock that's gotten really beaten up. Now, I don't have a position in it, but it's something I'm watching because, again, it seems to be basing between, let's say, $30 and $34 a share. And if you're losing weight, especially after being home, and we know that obesity has been a huge problem in this country, if you all of a sudden want to go out and finally date because you feel good about yourself, Match has Tinder. And as far as I know, listen, I've been married for a long time, but as far as I know from my single friends, those are still the hot places you go if you're looking to hook up. Yep. So I would watch something like that too.
Shifting back to sort of what's happened in the market in the last week plus, growth stocks in particular gotten beaten up, and sentiment is really dipped. Consumer sentiment, but also just sentiment among investors. AAII is showing that fear is pretty high right now. Do you see that as a contrarian play, or great time to buy now that sentiment has gotten this negative?
Well, yeah, let's put some price narrative on that. So one of the most interesting things happening in the market right now is we like to measure risk from the viewpoint of the long bonds versus SPY and the long bonds versus junk bonds. And both of those indicators are showing long bonds right now outperforming both the S&P 500 and the junk bonds, which is risk off, except junk bonds are sitting really high right now. So there's your anomaly. Obviously, there is still a huge appetite for high yield, high risk debt, right? Companies that don't have good balance sheets, but the bond traders are willing to be in them because of the big payoff. So that's telling me that the fears of, let's say, a credit default or even a major recession right now are more fear than reality. So I think that could be the contrarian play, just like extreme exuberance was obviously the contrarian play to start cashing out or taking profits or even going short if you were so inclined.
Right. Yeah. No, I like that perspective. Brad, do you have one last thing?
Yeah, I'm curious. Is there a case to be made that that junk bonds are maybe just a money supply play? Right. Like if we're going to keep pushing up federal deficit level or, outstanding federal debt, that money has to go somewhere. Treasuries are getting that a little bit of a maybe flight to safety-ish impetus behind them right now. But I wonder if maybe if people are moving out of equities, if junk bonds becomes like the next tier down on risk.
Well, from a historical standpoint, I would think that would be a little bit scary to be piling into, companies that have terrible balance sheets, but pay high, because if we have a real recession, those things are going to get killed. So I'm looking at it more from that standpoint. Not so much is that a sign of where people are putting money because it's a safety play, but more that it's a sign that they're taking advantage of the fact that, with the yield curve, number one, and number two is that whether or not we don't know yet whether this is an absolute brilliant move on the Trump administration to keep threatening these tariffs higher and higher, which then of course brings EU and China to the negotiating table so that we come into some kind of a trade agreements, which would then be very good for the economy. We don't know that yet. And that of course would avert a lot of problems, number one, and certainly a recession. I like to look at it more that way. If I start to see the junk bonds really sell off, I would get nervous. In January and February of 2020, before COVID was even a headline, the junk bonds were starting to crash. And we liquidated everything and went into bonds back then. Right now, I would want to see more flight to safety to bonds and less movement in the junk bonds to think that perhaps it's just bond traders piling in because they think that's the next big play. I don't know, but I could be wrong.
Yeah, well, that's interesting. Well, if you want to read more from Mish and from marketgauge, we have an offer exclusively for today's listeners. If you go to cabotwealth.com/street, you can download a report from marketgauge, get 3 stocks ready to move now. The report is available for a limited time only, and when you opt in, you get the PDF report and access to a quick video, which you'll discover how to use the 3 stocks in a way that has beaten the market by 3 times to over 10 times. Build your wealth in your spare time. Leverage market edges that professional hedge funds have used to get ahead for decades and more. Again, go to cabotwealth.com/street to download your free report from MarketGauge. Mish, thanks so much for joining us. It's really great to get an outside perspective, and I like the way you look at things. There's things we haven't even talked about a whole lot on. We feel like we talk about just about everything in this podcast, and you hit some things that we haven't even gotten into. So thanks for sharing your perspective.
Well, thank you so much. And thanks, Brett. It was nice to meet you as well.
Yep,
and go check out the offer that we're doing with you guys on from MarketGauge, from Cabot, and my Outlook 2025, because I think that'll give you a lot of information on how I think.
Marketgauge.com, you can get, what is it, your market outlook for 2025 with the 10 picks. Yep.
Correct.
Right there. Great. Thanks again, Mish. And we'll see you again sometime down the road.
Love that. Thank you so much, guys.
Take care.